The Federal Reserve is getting ready to turn on the money printers, or at least that's what the rumors are telling us. In today's videos, we're going to dive into these rumors. Is this the truth, or is this just another hype story? If you're excited to find out the truth behind these claims, gotta like and subscribe down below, and let's hop in to today's video. Now, guys, I think most of us at this point have heard the rumors going around on the timeline that the Fed is getting ready to start QE, that they're going to start printing 30, 40, $50 billion a month to buy back bonds, to buy back treasuries, injecting liquidity into markets and sending our bags higher. But the reality might be a little bit different. So let's dive into this and find out just what's going on. First of all, let's set the stage. So have a look on your screen. This actually explains a lot of where we are in the cycle and why. The Fed ran quantitative tightening for a little over a year last cycle. Look at the significant difference between this cycle's quantitative tightening drawdown and last cycle. Almost 3.5 years here, and they've reduced it by a much larger amount. And this goes back to my thesis of why we haven't had an alt season, why the cycle feels so different, is because this tightening phase lasted a lot longer. And so the Fed has been pulling liquidity out of the system. And on this chart here, you can see a couple different things. Right here, this is Fed net liquidity, how much liquidity the Fed is holding. And this middle line right here, this is from Andreas Steno over at Real Vision. This pain level here, we are significantly below this pain level. And this is contributing to a lack of liquidity in the bond market. And that has been causing a lot of the volatility. We've talked about this a lot on this channel. When the bond market struggles, markets struggle because there's not enough liquidity to allow for that market to function smoothly. And so this yellow line right here, spiking higher, indicates to us that there's volatility in the bond market or not enough liquidity to refinance debt. And so when you have refinancing tensions, you get economic crises. On the other hand, when you have more liquidity than is needed, you get asset bubbles. And right now we're trending up into those refinancing tensions territory. And that's evidenced by this yellow line here indicating tensions, Fed liquidity down below the pain level, and the Treasury general account sucking up all the money in the financial system. And so whether or not the Fed is going to start QE soon, there's definitely room for them to do so. There would be a good cause for them to start buying bonds, increasing liquidity, and helping the bond market function smoothly. In fact, just a month ago, New York Fed President Williams said the Fed may soon start buying bonds to manage market liquidity, otherwise to help out the bond market, to help markets function smoothly. And so I've got Andreas Steno Larsen here. He's going to share his thoughts on what he thinks the Fed's next move might be. Take a listen.
If they take a more formal decision on this, it will probably be to launch some sort of light QE program, maybe buying, say, 40, 50 billion worth of T-bills every month. But to me, that is a suboptimal solution to this because, it will take 5, 6, 7 months to get us back above pain levels. In the funding market, if they only buy 50 billion a month and we have a gap of 250, right? That's at least 5 months of buying before we're back where we need to be.
And so what he's saying here is that the Fed might start injecting about $40 to $50 billion a month, but that's almost not even enough. Because again, if you look at his chart here, we're well below this pain level. $40-50 billion a month is not enough to bring us up above this $250 billion gap. So the Fed, he argues, might have to do more sooner. Now, the reality is the Fed hasn't actually told us. They haven't come out and said one way or another what they're going to do, and that's something they may do tomorrow at the FOMC. However, several large hedge fund managers do expect them to do so. So we've got Goldman Sachs here. We expect reserves to be slightly above $3 trillion by late 2026, assuming reserve management purchases begin in January. And so they're showing here that the Fed balance sheet is, kind of contracting, but then they kind of forecast, this is a forecast zone. They forecast it might, start to pick back up, the Fed coming in to do some liquidity injections, to do some bond buying back. So reserve management purchases. Now, what does this mean? Let's dive into this because as we all know, people are privy to QE. People know the game. They know quantitative easing means liquidity injections, means prices go higher. And something that I've said before, maybe not on this channel, is that they will do QE, but they'll probably call it something else. Well, get ready for reserve management purchases. We got an article here from the Financial Times, and I want to slide down here. Money markets continue to signal the need for Fed to advance to the next phase and start reserve management purchases. What are RMPs? Is it just QE redux? So essentially, it's just another name for quantitative easing. They'll call it something different because we know the game. We know the strategy, so they have to shift gears a little bit, keep us on our toes. So let's have another look. This is Bank of America Global Research. Exhibit 2, Fed bill buying expectations. Fed is expected to be buying bills in meaningful size in 2026. And so you can see that this number kind of just goes up and to the right, a breakdown of some different types of bills. Not important to get into the weeds here on this, but the idea is that they're going to be injecting liquidity in some form to buy back bonds, to inject money into markets. They won't tell you that it's for the purpose of pumping markets, and maybe it isn't, but the reality is that when the Fed starts to print money and they start to inject liquidity, that typically has a positive effect for risk assets, Bitcoin, Ethereum, altcoins, as it trickles down. And so no video about speculative QE would be complete without a clip from Michael Howell, the liquidity godfather himself. Check out his thoughts on what the Fed may be doing in 26. Have a listen.
So is quantitative easing going to be back in 2026?
Well, my answer is absolutely yes. I mean, they more or less said they're going to do that. As I said, there may be finesses to that. They could argue that it's not because it's not directed at the real economy. It's only involving treasury bills. But as I say, that's sort of dancing on the head of a pin in many cases. The fact is that Fed liquidity, on my definition, goes up and bank reserves will rise. The problem is that bank reserves will still, at the end of the day, even after these measures, be below the adequate level that they previously were at, which is about 3.3 trillion.
And so there you have it from the man himself. QE likely to restart in 2026. And then you'll also notice he mentioned something that Andreas Steno said in the last clip, that these purchases won't be enough to get them back to the levels they need to be. Now, if I'm speculating, I'm going to go ahead and say that they'll keep this level of purchases to where it's not enough, as they're saying, that they'll do the purchases, it won't be enough. But then in May, we get a new Fed chair, and a lot is going to change. We'll do a video on that soon. But really, I think what they'll probably do, if I had to guess, is they'll buy back. It won't be enough. The new Fed chair will come in, and then maybe they'll take a more aggressive balance sheet position, a more aggressive balance sheet strategy. Again, that's a speculation, but that's kind of how I'm looking at this right now. And so looking ahead to tomorrow at the FOMC, do we think Powell is going to announce some form of QE, some form of asset purchases? We've got a nice little rumor circulating here from Zero Hedge. Former New York Fed repo guru Mark Cabana, Powell will announce a $45 billion in T-bill purchases on Wednesday. And again, that goes back to this reserve management purchases, buying back bills and adding to bank reserves. And so while we don't have definitive evidence, we don't know for sure one way or another, although tomorrow we may, it's safe to say that this probably needs to happen sooner than later. You have multiple experts coming in and saying that the Fed is very likely to start some form of QE, some form of money printing, because they have to. The bond market needs this. And this is something I've been saying on this channel. The Fed can talk tough. The Fed can say they don't want to inject liquidity. At the end of the day, if the bond market starts to come under pressure, they're going to respond. They're going to do what is necessary to keep that operating smoothly, because the alternative is watch the entire thing crumble around them. That's not ever what they're going to do. And so in terms of an actual decision on this, we're going to have to wait and see what Powell says tomorrow. But I hope in the meantime, this has helped you gain some clarity, helped put these rumors into context, and helped you become a more knowledgeable investor. And if you want to continue to gain insights and knowledge to help you become a better investor, you got to like and subscribe down below. Leave me a comment. Let me know if you've learned anything. Has this video been helpful for you in sorting out these rumors? In any case, thank you for being here, and we'll see you in the next video.